And a very related one that is kind of similar to what we just talked about is the idea that the US market is too concentrated in big tech stocks. So on the left side, and I guess this is kind of the chart itself is doing that playing with numbers thing where they don't have zero as the baseline for the chart. But I think what I take away from this, interestingly, is a little bit different. So there's a lot of talk about the Mag 7, how much Nvidia or Apple or whatever it is make up of the S&P 500. And it's actually not like that different than what it has been historically. So the top 10 stocks and the percentage they make up of the S&P 500 is shown on the chart. It's very common for it to be somewhere between 20 to 25% of the index. And in the last handful of years, it has grown, but it's grown to be like, somewhere between 30 to 32% of the index. So it's not as if that whole idea is new. There's always very heavy concentration at the top of an index. It's just kind of that old rule, the 80-20 rule or whatever you want to call it, that the biggest names are almost always going to be a much more disproportionate share of any given set or any given index. But not only is that the case, but like we just talked about, if you're a diversified investor and you've got international, you've got not just the S&P 500, but you've got the total US market that includes small caps too, mid caps, all of that. You've got bonds maybe for a portion of your portfolio. Your portfolio is even less concentrated than even the S&P 500 is. So it's not really something to be too worried about. And especially when you consider the third reason that it just reflects the market's wisdom that those companies are the ones earning the most money right now. Like Apple prints money selling iPhones, iPads, all of that stuff. And so to own a lot of that is just a reflection of the fact that the market sees Apple as a really great investment opportunity. So even if you're an index investor and you own a lot of Apple, just know that that means that so do all the non-index investors, because all the index person is trying to do is to mirror exactly what all the non-index people are doing on average as the wisdom of the crowd. And the only little caveat that I'll give on this one that I think is just totally a fair sentiment is if you are one of the many people who works in either a big seven company or an associated industry, like you're in that big tech space, a lot of times they will have compensation that's driven by, say, like RSUs or the performance of those big tech companies. And so you're more concentrated than the average individual might be just by nature of your personal employment and the way that you earn your income. If that's you, it may make even more sense to have a bigger international tilt, bigger tilt to small caps, something like that, so that you move your total exposure a little bit away. But for just the average person investing, there's no reason to be concerned about this current status of the market at all. And say you continue with the broad market index fund, just like we would always recommend.